In this hospital economics video, we're going to talk about a common economic value proposition that a lot of medical device companies use when talking to hospitals. At Technology Access Partners, you might hear us talk a lot about value propositions, clinical, economic, quality. We also call them targeted messaging when those value propositions are communicated in a particular way to certain hospital stakeholders. A very common economic value proposition that we hear all the time is a reduction in length of stay. So medical device companies communicate to hospitals that if they adopt and use their technology, they can reduce length of stay by a certain percentage, which will result in a certain amount of dollar savings. It sometimes goes like this. Our product can reduce your 5-day length of stay by 20%, thereby saving your hospital $1,500. Now, how did they arrive at that $1,500? Well, at this point, most companies and most organizations, even hospitals themselves, oftentimes are using an average per diem cost analysis. An average per diem cost analysis works something like this. They accumulate all the costs for a group of patients for a particular procedure, total it up, divide it across the patients, and you get an average cost per stay or per patient, per discharge. Let's say that average cost per discharge or per stay is $7,500. They then do the same thing with the length of stay. So they total up all of the lengths of stay for all the patients for that particular procedure, and then they divide it by the number of patients, the number of discharges, and they come up with the average length of stay. In this case, let's say the average length of stay was 5 days. So how do we come up with the average cost per day or the average per diem cost? Well, we divide $7,500 by 5, and it gives us $1,500 a day. Therefore, using the economic value proposition of saving a hospital a certain amount of money on the length of stay, we say, okay, if we can save the hospital 20% in their length of stay, that accounts for 1 day, hence $1,500. So if the average per diem cost method isn't as accurate, why do companies and hospitals use it? Well, most hospitals don't have a cost accounting system. And without a cost accounting system, hospitals can't exactly determine what a particular patient with a particular procedure actually costs them. So they tend to default to an average cost methodology. But at the same time, hospitals that do have cost accounting systems can accurately identify their actual per diem cost. And it's not actually distributed evenly across that entire length of stay. Before we delve any deeper into the average per diem cost analysis and the difference between actual cost and the average per diem cost, let's talk about the language of cost. So first, you have variable direct cost. And variable direct costs is basically the costs that can be identified associated directly with the care of an individual patient on a particular day. Things like lab tests, implantables, high-cost implantables, disposable supplies, those are variable direct costs. And if you don't have that patient and you're not doing that procedure, you're not incurring those variable direct costs. Then you have fixed direct costs. Those are costs that are expenditures that can be identified with a particular hospital department, but not with a particular patient. Indirect costs fall outside those individual departments or service lines and account for things like patient accounts, materials management. So indirect costs are really those costs that are spread across the entire organization. If you combine your fixed direct and your indirect costs, you're getting your hospital overhead costs. And when those are added back to variable direct costs, they're often called fully loaded costs. Now again, because hospitals that don't have cost accounting systems, number one, they can't identify their variable direct costs exactly on a per patient basis, and they can't accurately allocate their hospital overhead costs. They kind of use a rule of thumb, and they determine, okay, if on average our variable direct costs are this amount of dollars, we'll typically double it. We'll add an additional 50% on top to arrive at fully loaded costs. So again, it's a lot of calculations that kind of average costs against departments, against individual patients, but you're not really arriving at the total cost accurately. So typically the average per diem cost methodology is used because, again, if hospitals don't have a cost accounting method or cost accounting system, they can't accurately identify what a particular patient costs them. a study was performed and published in the Journal of the American College of Surgeons that looked at a hospital that actually had a cost accounting system. And what they did is they took a look at what did patients actually cost, or what was the distribution of costs for a group of patients based on that length of stay. And what they found out was that about 40% of the total cost of length of stay was actually incurred in the first 2 to 3 days. So after that, the percentage of total cost dropped off significantly. And that makes a lot of sense. I mean, coming from hospital finance, I could tell you typically if there was a high cost implantable involved, sometimes you'd incur as much as 50 or 60% of the total cost in those first 2 to 3 days. Because obviously you're going to have your OR, you're going to have expensive implantables, you probably, if you have an ICU stay, that's the most expensive bed in the hospital. That's all going to happen within the first 2 to 3 days. And then again, if the patient is stable, they'll be discharged to a lower cost med-surg bed and then eventually discharged. So in this study, they took a look at a 5-day length of stay, for example, and this was across 522 trauma patients. And they took a look at patients that had major surgery, and they considered that greater than $2,000 in surgical costs. And they said the last day variable direct cost as a percentage of the total mean or average cost was 3.1%. So if you think about that example where we looked at the average per diem cost being spread evenly across all 5 days, that assumes that that 20% of the cost is occurring in the 5th day, and that's how much is being saved when 20% of the length of stay is reduced. But we see that's not really the case. If you look at this study that they did with a cost accounting system, using a 5-day length of stay, only 3.1% of the total cost was incurred in the last day. Therefore, if we said, hey, we can reduce your hospital length of stay for this group of patients by 20% one day, you're really only saving the hospital 3.1% of the total cost. So again, length of stay is important, and the cost associated with that, certainly being able to save that last day and those expenses is certainly valuable, but we as medical device people need to recognize that it's not exactly as important or saving as much money as we really think it is. So ultimately, we have to look at other kinds of value propositions. What else can we bring to the table that might be even more impactful to a hospital? So other important value propositions could be things like reduction in intraoperative or post-op complications. And those are things that will drive up the variable direct cost for a particular patient. So it may or may not actually extend the length of stay, but it may keep that patient in that ICU bed longer. It might make them use additional disposables. So it will typically drive up the costs. Other things like reduction in readmissions, given accountable care right now and the readmission reduction program, being able to save a hospital, with Medicare patients primarily, being able to bring down the readmission rate for certain patients will help them earn back their withhold amounts. Increased patient satisfaction, we consider that more of a soft value proposition because right now under accountable care, the Affordable Care Act, patient satisfaction is important, but by the time it really gets translated into how it impacts a hospital earning back their dollars, it's a really difficult thing to tie together. So I often consider soft value proposition. Another hard value proposition, reduction in hospital-acquired infections, or HAIs. Hospitals get penalized for hospital-acquired infections, so they're aggressively trying to reduce HAIs. Another value proposition, reduction in return to surgery events. And you might consider that post-op complications. But these are all of a bunch of different value propositions that are more impactful than just reducing length of stay. And the key to remember is, ultimately, the only time you're really helping a hospital by reducing length of stay is when they don't have enough beds. In other words, they don't have enough capacity, and they really need to move the patients out quicker. So we call that throughput. It's the same in the OR when we talk about saving a few minutes of OR time. It only helps them if they can either put another patient in the bed or they can put another patient in the OR. Similar concept. So if a hospital has beds that are empty, they're only at, let's say, 70% capacity, a lot of hospitals are, then potentially getting that patient out of the bed a day earlier may or may not be significant to them. It's still an important value proposition, so let's make sure we recognize that. But at the same time, let's also recognize the true value of that value proposition.